thinking about the value of a public currency versus privately held shares in developing acquisition strategies, buyers need to keep in mind that in a majority of transactions done in the bank space, most of the consideration is in the form of the buyer's stock. In an industry acutely focused on capital levels, issuing stock in a transaction allows the buyer to capitalize the deal without accessing the capital markets. Stock also provides a nice alignment tool with selling shareholders, as well as a key retention tool for key personnel. Private stock or thinly traded stock doesn't provide for orderly exits and is very much open to debate and interpretation as to valuation. Public liquid currencies, on the other hand, are being valued every day in the market, and they provide a pathway to liquidity for selling shareholders. At a minimum, private illiquid securities are going to be discounted by sellers. And in most instances, most but not all, they're going to be disqualified entirely. Sellers don't like financing contingencies either. So what does this mean for a private buyer that wants to be acquisitive? In most instances, it means that they're going to need alternative sources of financing and capital lined up in order to accomplish their objectives. There's no question that in today's bank M&A market, sellers are placing a high premium on liquidity. And certainly, nothing provides liquidity and valuation certainty like cash. But in a transaction where the seller can take a buyer's stock that has ample liquidity, it can effectively think of that transaction as cash-light, except it's also giving its shareholders an option to address their taxes when they so choose. Provided, however, they have to be comfortable taking on the market and execution risk of holding that buyer's stock for some period of time. For sellers, particularly those with concentrated ownership, liquidity is very important to assessing how and when their shareholders will ultimately be able to exit. It's extremely rare that we see a seller willing to trade down the liquidity spectrum. But we do see instances where a seller will elect to partner with perhaps a less liquid buyer than another suitor, where the upside to the transaction is clearly higher and the seller's shareholders don't have an immediate to intermediate term need for liquidity. We also see situations where private companies will partner with other private companies who have a plan for a near to intermediate term IPO. And in those instances, we've often seen the selling shareholders ultimately receive additional upside to the valuation that they received in the transaction. Deals between private companies really only come together when you have two parties who are both willing and able to look objectively at, identify, and acknowledge the relative value that each brings to a combined entity. Ultimately, the objective here is to set and define an exchange ratio that benefits both sets of shareholders. In order to do that, you have to look at a whole range of factors and analyze those factors objectively. A few of the more critical ones would be the size and composition of the balance sheet. And here we think about the size and relative risk of the loan books, core deposit funding, and capital basis. We also think about the relative stability and diversification of the revenue streams of each company, as well as the level and quality of the earnings that they bring to the combined entity. And then finally, we think about the ability of both companies to grow their businesses and correspondingly grow their earnings in the future. You can then ascribe some incremental value to the company that's losing control in the transaction, the target, as well as the company that is bearing the brunt of cost savings. Third-party advisors providing valuation perspective and expertise and structuring advice help in these situations, but ultimately you also need two parties coming together who are honest enough with themselves and trusting enough in the other to find their way to a deal where they're both better off together than on their own.